Welcome to Real Talk, Real Estate Discussions with Andrew Kirsch. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsch.
Episode 18 of Real Talk. I was out last week. I had a good excuse. I had to go see my Northwestern Wildcats play in the NCAA tournament up in Sacramento, a great first round game against Boise State before coming back to earth and losing to UCLA in the second round. Overall, very proud of my Wildcats. It's been an interesting couple of weeks in not just the real estate world, but the general economy and the banking industry. From Silicon Valley Bank to Signature Bank, First Republic Bank, Credit Suisse, who knows, maybe others. I'd like to do a podcast in the future, in the short future, on the banking industry. So I'm going to try and line that up. What this means for the real estate world, it just means more concern, right? More uneasiness. And so transactions that we're having a tough time getting done in just the economy that we're in and the interest rate environment that we're in, it's even more challenging. Some buyers are taking advantage of this trepidation and choppiness and getting even more discounts on deals that they're able to transact on. So we'll definitely keep abreast on what's going on in the banking industry and hopefully do a podcast soon. Meanwhile, for this episode, really proud to have Adrian Berger of Cypress Equity Investments, the managing director over there. Cypress is a national Class A multifamily developer. Each year, they average about $1 billion of new construction. Right now, they've got 8,000 units in the pipeline. Adrian, actually, our first non-US podcast guest. We'll talk about living in Australia, coming to the States here, the differences between Australia and the US, and of course, talk about real estate and construction and value-add projects that he's doing throughout the country. I know you'll like it.
Hello, welcome to another episode of Real Talk. I am here with my good friend, Adrian Berger, not Berger, but Berger, from Managing Director, Cypress Equities Investments. Adrian, how you doing, my man?
I'm great, Andrew. How are you today?
I am good. So look, I really appreciate you coming on. It's just a really interesting time in the market, but I think you're our first non-US born guest on Real Talk. So let's just get that out of the way. Okay?
Nice.
We are going international. And so why don't you tell our audience where did you get that, fantastic accent? I don't think you got it from like Houston, Texas or Savannah.
Yeah, it's not from Staten Island, that's for sure. It's I'm from Sydney, Australia originally, and fortunate enough to make my way to the US about 14 years ago to New York. I was in Asia before that, and I've been in LA for about 8 years. So grew up in Sydney, great city to be a kid and great place to grow up. But there's a lot of opportunities outside of Australia, and I just was following a path to those, and that landed me in the States.
So this is a random question, but where were you January of 2010?
I was in New York.
Oh, so then we didn't see each other because I celebrated my honeymoon in Australia.
So I just missed you by probably like 5 years.
Only 5 years. Okay. All right. Well, I had a great time. Sydney, Melbourne, and Hamilton Island.
Oh, Hamilton Island is beautiful. I took my wife there.
Yeah. So let's get right into it. Tell us about Cypress Equities Investments. What does it do?
Yeah, Cypress Equity Investments, we're a national institutional quality apartment developer and operator. So our headquarters is here in LA, and we have offices in Dallas, Denver, Florida, New Jersey, and Chicago. The company's been around for more than 20 years, starting off by buying apartments here in LA. And then since 2010, we've been primarily focused on apartment development, and also more recently, getting back into acquisitions again. So yeah, we're just a great Class A apartment developer. We do about $1 billion of new development starts per year, and we currently have about an 8,000 unit pipeline of development across the country.
God, so you said 8,000 right now in development, or is that outside of California, or that's in total?
That's the total across the country. In
Okay.
California, in LA specifically, we probably have about 2,300 units in our pipeline. Most of that in Santa Monica. And then we have a very large pipeline in Dallas and a nice pipeline in Denver. And we're involved in 2 master plan developments, one up in the Bay Area and one in Boston, which will be sort of 10-year type continual development projects.
Got it. And so, the regulatory, let's just cut right to the regulatory market,
Sure.
regulatory framework and structure, and of California, and specifically Santa Monica. I mean, you are definitely brave and patient. What is the average time that it takes to entitle a project in Santa Monica?
I think on average, it's probably around two and a bit years to get entitlements and permits in Santa Monica. I mean, it obviously depends on when you're actually starting that process and where their sort of zoning code updates are up to. But when the zoning's in place and you can make an application to the city, it's taking about two and a half years to get through that process to get a permit to break ground.
I actually thought you were going to say longer. So
it used to be longer.
Yeah.
And I think it depends on, again, when you're catching the city and when you're catching what they're doing with their zoning code and which part of the city. So the downtown had an updated code and other parts didn't for a while. But generally speaking, it's not as bad as it used to be. We definitely have seen longer entitlements. One of our projects took nearly 5 years to entitle. That was via a development agreement, which is highly negotiated. But if you're doing more of a typical streamlined process now, it's about 2.5 years.
Yeah, and how does that compare to other parts of the country?
It's interesting. Everyone, when we started expanding around the country, all these cities were very proud to tell us how much faster they were than California. But I think that those cities also weren't really prepared for the influx of developers from all over the country into these growth markets. And I think that initially some places were way faster, but I think in general, most cities, and it's hard to generalize, and I don't like generalizing in our industry, but to get a site plan approval or an entitlement can typically take like 6 to 12 months in a city. And then the permitting is usually a little faster than it is in California. I mean, that's the part of the process in Santa Monica that's currently taking the longest. It's taking, a solid 12 months to get a permit. So yeah, I think other places we typically see anything from 12 to 18 or 24 months, depending on the market.
And so everything that Cypress Equity Investments that you guys are doing, is it ground up, or I think you may have alluded to the fact that you might be now buying some existing product or
Yeah, I mean, the last 13 years have been really principally focused on ground up development. I'd say in the last 18 months, we've been more and more focused on trying to identify existing assets as we were seeing, cost of construction go up, and we're seeing assets selling above replacement costs. We just kept developing and keeping our eye on that. And obviously, with what's happened with the Fed in the last 9 months, we've just seen a really big change in what things are selling for, and yet hard costs haven't really diminished. They're sort of growing more slowly. It depends on the submarket again. So we saw an opportunity where we could start to maybe buy existing assets again, below replacement cost. But it's been challenging because obviously we're in a bit of a fluctuated market and capital's not really that active. So it's really about identifying really good opportunities that might not just be straightforward, like I'm going to go buy this building. It's more, or maybe someone's having a bit of a hard time, with their capital stack or their asset, and we can come in and help. And that way, help them get out of whatever situation they're in. And that way we can become part of an ownership of that asset. So that's one of the ways we've been approaching it. But yeah, we're also very interested in just buying assets as well, and have some capital partners that want to do that with us.
So how do you, I look, we spend on this podcast a lot of time talking about the capital markets, and definitely want to get your perspective. I would say before the recent Fed movement over the last 9 months or so, how did CEI typically capitalize their deals, and how has that changed in today's environment?
So our most typical structure is on the development side, we get construction financing. Typically, it was around 60%. And the balance of the equity, we were bringing in an institutional third-party LP for 90% of that. So CEI putting up 10%. That's made up of our principal's money, and we also have a family office that invests in some of our deals on the GP side.
Before even construction, when you guys would take down land, how would you capitalize just the land, the unentitled land, or would you wait and not take it down and purchase it until you got entitlement, and then you would be ready for a construction loan?
Yeah, it's a great question. So we do that. We do all of those things in different places. So in markets outside of California, like say Texas, Colorado, Florida, it's been more common that you could get a longer escrow, like an option over the land, and really close once you've got an entitlement or a site plan approval, or even a permit if you can get that length of a contract. In places like LA, where transacting quickly is more normal because there's so much more competition, and that's just the way business is done here, or has been done here for a while. We were closing on those deals with a land loan and our own capital. We were fortunate enough, during COVID, we had a very strong acquisitions effort, specifically in Santa Monica, and we had a capital partner that wanted to be, within that strategy with us, and they came into those deals early and took down land with us. But that's very unusual. So most typically, we're trying to find as much time as we can. So right now, actively looking to buy sites still in LA and Santa Monica, and most of the offers I'm putting on the table are trying to get a long escrow. It's just less risky for us, and it's also better for returns. So we're open to transacting in a myriad of ways, depending on what's custom, but also what works for the deal. Right now, we're trying to, like I said, get as much time as we can.
Yeah. So pivoting to just today, what is the market like, both for unentitled acquisition loans? I don't want to do here. I'm a lawyer, right? So I don't want to do a compound question. So let's just start with that. Is there a market today for unentitled land loans?
Yeah, it's shrunk a lot. And I think that we're fortunate that we've got a great track record and a reputation. So we have some very strong relationship lenders that are still open for business. But the cost of that debt has really gone up tremendously. And, it's impacting land value, and it's making it very, very hard to do deals, because unfortunately, land owners and land sellers, property sellers, are typically the last people to realize or accept that the market valuation has changed. And a sub-market like Santa Monica, for example, that's exacerbated. So it becomes increasingly challenging when you can't meet their expectations, and that's a lot of that's to do with just the cost of debt and the availability of that. So it definitely exists, but it's a very small group of lenders at the moment.
Yeah, and what are non-entitled land loans costing, and what type of leverage are you able to get, just in general?
On average, it's like 50% of the land and your pre-development cost, and then rates are sort of anywhere between 10 and 12%. So it's expensive if you think about buying something in a place like LA or Santa Monica, and you have 2 years until you can put a shovel in the ground, and let's say your all-in cost to do that with land and pre-dev is $20 million, like you're spending, millions of dollars just carrying land, and that's got to, that has a real impact.
Yeah. And so now take me through, once you have an entitled site, how does the construction finance market, how is it today, compared to what it was 9-12 months ago? And also the sources of equity, has that changed?
Yeah, I mean, the construction loan market has also just shrunk a lot, both from an LTC standpoint and from the number of lenders out there. So I'd say where we were at 60 or 65% before, we're at sort of 50, 55% now. Maybe you could still get someone a bit higher than that if you've got a lot of long-term relationship with them. But it's challenging. There's less and less groups out there looking to do that. I mean, we historically have only done non-recourse, and so we can still find those lenders. But a lot of our go-to lenders are kind of on hold right now. So that's the lending side. On the equity side, there is much less interest in development now than there was before. I mean, even towards the beginning of 2022, prior to even the rate increases, I think equity was starting to really pull back because I think sites were really expensive, costs were going up, and they were just a little nervous about that, all in basis. So we've been seeing that effect for a while. I think right now we have a few specific partners that would look at specific submarkets and specific product types. But I think generally it's very, very hard to find shovel-ready equity right now.
Yeah. It's the one, there's a couple of areas that we're still busy transacting. Construction is still one of them. Yes, it's slowed down significantly, but capital providers' thought process, and perhaps your own thought process, is, it takes 2 to 3 years to build, another year to lease up. And so by the time you come to get to market to sell or to refinance, we're now looking at 2026 maybe, right? And so we'll be hopefully well past what we're going through now. Is that what you guys, how does that factor into the decisions that you are making?
Yeah, we agree with that philosophy. I think part of what we're thinking is that we would prefer to break ground in 2024 than in 2023. We would love to break ground in 2023. We just think there might be more capital in 2024 for it. But yeah, I mean, the long lead time of development, like you asked the question before about are cities faster outside of California? And yeah, they might be a year faster or 6 months faster. But to build a 300, 400 unit building, it takes 2 years, really wherever you are. And it takes at least a year to lease up. So yeah, you're talking about from buying the land to getting, it stabilized at, at least 5 years. And we agree. And we think that the fundamentals in many places are still pretty solid, and that there's not a lot of development that's going to be happening, in the short term here. And so we might find that once we work our way through this economic, uncertainty, and we start looking at these markets again, and all the new supply has been absorbed, everyone's going to be like, we don't have enough apartments. And then everyone's going to start, piling back in again. So it's that's the cycle. So we're trying to get ahead of that a little bit and strategically look for opportunities in markets that we like, and hopefully structure contracts in a way where we can do the pre-development work while we're under contract and haven't closed yet. And by the time we get ready to close with a shovel-ready project, the markets are in a little bit more stable place and we can get out of the ground. That's sort of our general thinking on the development side.
And so in terms of the equity side of things, as there's fewer and fewer capital providers, so how are you backfilling the equity need? Is it through preferred equity? Is it through syndications and going to the private capital route? Is it co-GPing? I mean, what are you doing
for deals that we're trying to get out of the ground, or?
Yeah, or deal. But how about just throughout the whole portfolio, as it's tougher to get capital. I mean, you walk around these conferences, right? From
Yeah.
IMN to NMHC to any of these others, and they're crowded, right? Because we still have all of our business development budgets, but you're walking around and you're talking to the who's who of institutional joint venture equity providers, and they're window shoppers, right? They're looking for extreme distress, something with a story, but they're really not transacting. I don't want to say they're not open for business, but they're highly selective.
Yeah.
And so, assuming they are really not, there aren't as many at your disposal, right? As opposed to a year ago. Where are you going to find equity?
Well, I think first off, we're being much more selective about the things we're trying to control, and a lot of that is, happening through conversations with some of these partners that we know very well, asking them, and it's sort of become more of a back and forth on, what does a great deal look like for you in this sort of category or in this area of the country, or et cetera. And then, my job is to go and find that, right? Find that needle in a haystack a little bit. So we're starting off first by doing a little bit more upfront sort of qualifying on where they would transact and what those metrics might look like. And then really sitting back and assessing, like, where can we potentially do that? So that's sort of on the new business side of things. We've always been a very open, creative group when it comes to the capital stack structuring. And I think that comes from, our principal down. He's always been very strong on that side. And so we are very open to all kinds of structures. So we've done pref deals, we've done land JVs, we've done straight purchases, we've, syndicated our GP position. We've done, a lot of the crowdfunding deals. We did a lot of those, in the last couple of years. And we've also been trying to find alternative sources of capital that might be a bit more longer term view, or might not be traditional institutional, but, family office route, for example. So we're just, trying to take this time to pick the right deals and then try to match those up with the groups that we've been communicating with. And it's tough. Like, it's right now, no matter where you are in the country, there's a big disconnect between buyer and seller. And even if you do land something that you think is really good, then you got to go out and really convince that equity partner that it's something they should take a risk on today. And that's, I think, one of the hardest things right now.
Yeah. And so when you're underwriting deals today, ground up deals, has your return on cost equation or pro forma changed today versus what it was 12 months ago?
Yeah, definitely. I mean, it's just gone up, right? It has to, because the cost of capital has gone up. So where we might have been solving to, I don't know, a 5.25, 5.5 untrended in LA, for example, and, assuming a 4 or 4.25 exit cap rate and trying to get that, typical 150 to 200 basis point spread. We're now trying to get closer to a 6 if we can. It was super hard. And then we're expecting an exit of 4.5 to 4.75, depending on which submarket of LA. That's specific to LA. And that carries itself through. We're also super conscious about basis. I think that return on cost is a metric that we look at closely. Basis is a metric we're looking at closely. And then also on the deal level metrics, a lot of the LPs want a higher return, higher IRR, just for the perceived risk in the market right now. So it's, you add all of that up, and then you also know that it costs more to borrow money to do these projects. And, you can see straight away land value that was here is now going to be there, if at all. So it's made it very, very challenging. You talked about political environment in California. I mean, the passing of these transfer taxes in LA and in Santa Monica has had a really massive impact on deal returns. I mean, to the tune of 200 to 300 basis points of IRR. So
yeah. So it's funny. The LA one gets all the publicity, over $5 million threshold, and then a $10 million threshold. It ends up at 5.5% tax over, what it currently is, which is, maybe 45 to 50 bips. So all in, the transfer tax on a large deal is going to be 6% in the city of LA. What is it in Santa Monica? What did the transfer tax
It's
go to?
I think it's 5.5 rounded. It's 5.5% over $8 million.
All right, so basically it's the same
Right.
on the types of deals that you're talking about.
Yeah.
It's a major impediment as I go throughout the country, speaking to clients at conferences, and they hear this, at least specific to LA, the ULA tax that comes into effect April 1st. And does Santa Monica's also come into effect April 1st, or
It's already come in. It was March 1st.
March 1st?
Yeah.
I mean, the people who are not from here are absolutely blown away
Yeah.
that we have it, and we'll see if it stays. There's obviously a lot of attempts to either overturn the law or to put a new ballot referendum next year. But for now, this is what you need to underwrite for, that your exit, you will have lost 5 to 6% of your value because of these taxes.
And it's the hardest thing is on the developer, because when you go through the waterfall and you get to that last hurdle, like that's where all that money's going. It actually then goes to the city instead of, and so you do all this time, take all this time and energy and effort, and take all this risk, so that's tricky. And then for me as an Aussie, having to learn the politics of this city in the country over 15 years, it's also just very fascinating for me to learn more about every day about this, the way laws are getting enacted in the state of California, for example, versus other places, and how important the local jurisdictions are. And so it's really had a massive impact. And I'll give you an example. So land value, now obviously there's a myriad of factors affecting land value today versus a year ago, but we are able to pay probably half or less than half of in land in Santa Monica than we could about a year ago. And that's a factor of, interest rates and increased return on costs and IRRs from investors and things like that. But the transfer tax takes a huge bite out of that. So it makes it very, very hard to convince a seller to do a deal.
So if land value has literally gone down 50% in 12 months, how are you even able to find deals? Because if I'm owning prime land in Santa Monica, and I would assume most of the time, I shouldn't assume, but maybe just ask this in a question. What's the profile of the typical seller of land in of your developments? Is it a mom and pop family generational owned asset?
Yeah, I'd say 75, 80% of it is that. I mean, I can speak specifically to Santa Monica, where we've done a number of transactions in the last 2 years. It's a lot of long-term family wealth. It's multi-generational, a lot of trusts, a lot of families, a lot of, sadly, families that don't see eye to eye, and that just adds a lot of time and difficulty in the process. A lot of the inherited generation doesn't understand real estate. They not interested in the real estate, and so they're happy to move on from it, which creates the opportunity. But you got to be really patient, and you've got to really understand what you're doing and understand the values of things, and just make the best argument you can that they should sell it to you.
Yeah,
that's really that's where it's tricky.
So the reason why I asked the question is, if I'm one of those families and I see my net worth, or at least with respect to this land in Santa Monica, go down in value by half, and I'm not forced to sell, and there isn't an internal family squabble, I just wouldn't sell. I would wait. I'd say, this is Santa Monica. I'm next to the ocean. It's going to come back in a couple of years. Yeah,
and that's a lot of the response that we get. So the challenge is, finding, again, it's like a needle in the haystack, is finding the situation where the site itself works, so you can get enough density, so you can actually pay something meaningful for land, and then figure out who the seller is and what's motivating them or not motivating them, and then trying to find a wedge in to do that. And that's when you really work closely with third parties like brokers and attorneys that have relationships. And we're very fortunate that we have a really good reputation and a great track record. So it allows us to get in front of a lot of people, and you've just got to kiss a lot of frogs, right? And at the end of the day, we also were successful during COVID, because I think there was a little bit more fear during COVID. especially most of the properties or all the properties that we're buying have existing commercial uses on them. And we don't buy any existing apartment buildings, and because you can't tear them down without going through that whole Ellis Act process. So, we're targeting retail shopping centers and office buildings, and those assets and those asset classes have been a little bit challenged. I mean, they're all tarnished with the same brush, right? Even though we know that some of those asset classes are still doing great, but those are the ones we target, and those have had some challenges over time. And you find that a lot of these ownership groups are tired of being in partnerships with people for a long time, or they're sick of California and they've heard about what's happening in Texas, or they've heard about what's happening in Florida, and they hear that there's better returns there. So they want to take their high value Santa Monica real estate, get rid of it, and then go and 1031 into another state that's easy to do business in, where they get a better return, where they don't have to think about anything and can clip a coupon. So, it's just about trying to find those groups, and it's hard.
Yeah. Well, so I want to touch upon a topic that you that we haven't yet talked about really, and that's the conversion of office buildings into multi.
Yeah.
And I hear a lot about that, especially from office owners, because they're scrambling. They're trying to figure out what to do with an asset. Talk about losing half of its value. I think they've lost much more than half of their value. Downtown LA, you can now buy large office buildings for under $200 a foot, which is remarkable. And so the hot topic, I don't know if I'd say controversial topic, is can you effectively convert these obsolete office buildings into a functional multifamily structure? Have you guys looked into it?
We're looking into it right now. We've looked at it over the years on and off. It's the answer is yes, but it's like very narrow band of buildings that I think would fit into it. And I think you talked about the cost to buy it, the dollar per foot cost to buy it, and I think that's a key driver. But aside from the money, it's the what you can convert it into and how much square footage you'll lose, because at the end of the day, these buildings were built as usually big floor plated office buildings that have 4 sides of windows. And if you're graduated from college and you're an associate, or I've listened to your podcast and about all the law associates that get stuck doing 100 hours a week, you're sitting right in the middle, probably near the photocopier with no windows, and that's just where you are. That's where the bullpen is. So when you think about what constitutes a legal bedroom, you have to have a window. And so that automatically just starts to make things difficult. And the thing is, these buildings are quite deep. So you end up losing a lot of rentable square footage, because you can't just have, a very deep railroad apartment with one window. I mean, you can, but it's just, you won't get the rents you need to make it work. So that's one big element, is like, what's the shape of the floor plate, and what's your loss factor ultimately? That's a really big driver. And then really the other part of it is, one of the reasons we like development, and I know hard costs have gone out of control the last few years, but you're signing a GMP, a guaranteed maximum price contract with a GC, and you have some idea of what it's going to cost to build. And it's all new materials, right? So you don't have to worry that when you open up a wall, what's in there. And so that part of it also becomes a little tricky, because then you've got to just really be budgeting in a slightly different way. I think it does work. I think you look at places like New York City. When I first lived in New York, I moved there at the end of 2008. So pretty tough time to move to New York, move to the States actually. And the condo conversion and the office conversion market was huge, because they had a tax abatement basically that really incentivized developers to buy these empty financial district buildings and turn them into condos. And they did really well. They were successful, a lot of them. I think that's because it's helping the basis. And I think that's a big driver here, as well as the floor plate issue that I mentioned.
Yeah. Look, it's going to be this city, this country has a housing crisis still. And
Right.
So, we've seen the repositioning of obsolete shopping centers into data centers, maybe industrial or other uses.
Yeah.
We're going to have to figure out a way to make these office buildings that are now either obsolete or not being utilized for whatever reason, whether it's post-COVID, work from home, people not wanting to be specifically at downtown LA, crime, homelessness issue. I mean, look at Century City. Century City is now receiving all of the tenants from downtown LA.
Right.
Downtown has become just like an apocalyptic area where vacancy, the stated vacancy is 30%, actual occupancy is less than half. So you see all these buildings, and with a housing crisis, how to repurpose it in an efficient, cost-effective way so it makes sense for the developer to do it.
Yeah, in some circumstances, it's like there's more land value sometimes than there is going to be building value. And we were assessing one, and the first thing I did was I looked how big the land was and how many units I could get, and then did a quick mathematical equation in my head, and I thought, okay, I can probably get to that. And then what they want is 3 times that, and I'm like, well, the idea of going through a process of refurbishing and redoing an existing building that's not going to be perfect versus just scraping and starting again. I think, look, at the end of the day, like converting it to residential is not going to be the solution for every single building, and I think that's, again, like there's a lot of like, oh, we'll just convert everything to residential. It's like not as easy as that. But for sure, a bunch will get done, and I think it's great. Like I think that a lot of those buildings have so much character. Look at some of those buildings that were built a long time ago, and they're beautifully designed, and they've got great facades, and they're very tall. That's always in our opinion, it's impossible to build high rise in LA and have it financed. So to be able to own a high rise office building and make it a residential building has a lot of benefit. I think you can get a lot of good rent, but it's got to be kind of the perfect building in a way.
Yeah. Are you ready for the world famous Real Talk lightning round?
Yeah, I was thinking about the lightning round today, and I was like, oh, I better do some push-ups and get myself ready. So
well,
I'm ready.
Given that you are our first Australian guest, it's going to have an Australian flavor in terms of some of the questions. Okay. Terrific. So, by the way, I think I mentioned this to you before, but my audience doesn't know. In 2000, I graduated law school, took the bar exam, wasn't cool enough to travel with friends of mine. I guess I wasn't well liked, and so I went on a Kentucky tour, which is an Australian-based tour company, I think. And on my bus throughout Europe, it was one of these like 30 days, 15 cities. 45 people on the bus. I think 35 of the 45 were Australians.
Yeah.
So
for how many minutes of that trip were you sober?
Well, what I'm going to say is it didn't matter if we were in London, Paris, Rome, Venice, south of France, Berlin, other cities. The first place that most of the Australian males would frequent was, where's the local Australian bar in these cities? So my first question to you is, what is the best Australian bar in Los Angeles?
Well, that's a good question. I don't know.
You can say New York as well.
Yeah. So actually, my favorite one in New York, because there's actually not that many. I don't think there's really a specific one in LA, but there was a place in the Lower East Side called Dudley's. And that was like in the Lower East Side, a great little hole in the wall, but it had a really good Australian style menu and a lot of beers.
Victoria Bitter, VB.
I don't think they served VB. It's hard to get Australian beer here, but they were like an Australian sort of bar, restaurant, pub. So that was one of my favorites.
Okay. One
tough question, actually. I got to try to figure out the guys that own EPLP are Aussies, and that's a pretty awesome spot too. The restaurant on the level below is mimicked after a very old, famous Asian style restaurant in Sydney, and that's a pretty awesome spot too.
Got it. All right. One more Australian question, and then I'll get into my real estate lightning round questions.
Okay.
If you could take one thing in Australia that you just absolutely love and you wish the United States had it, and vice versa, one thing that you could take from the United States and put it into Australia. So the best of both worlds, what would it be?
Ooh, well, it's got to be from Australia. It's got to be food based. So I'm going to answer that with two answers. One is Australian chocolate is the best chocolate you've ever eaten in your entire life. We have very interesting confectionery. So my favorite is called a caramello koala. It's a little milk chocolate in the shape of a koala with a cute little face. It's full of caramel. It's absolutely delicious. And then we have, it's kind of Australian, although it's Portuguese, but Australians kind of invented this concept of Portuguese chicken burgers. And they're not like fried chicken sandwiches. I had to learn that difference. They're thinly sliced grilled chicken with like chili and a beautiful soft bun, and it's incredible. So for years I've been like, how do I bring that to the States? And then I'm too busy trying to do real estate deals. I can't figure that part out. So I'd say that's what I would bring from Australia. Would be the food. The other thing that I think that I would love to have here in LA is if we had a proper harbor with river system.
Oh yeah,
a big boating culture in Sydney.
Yeah, like Sydney. It's gorgeous.
Yeah,
it's the most beautiful city I've been to.
Yeah, I miss that. I mean, you can go boating here in Marina Del Rey, but you're in the Pacific Ocean, like that's it, right? So I'd say those are a couple of things that stand out for me. And then from America going back to Australia, I definitely think that the American can-do attitude of anything's possible, and you could start from here and end up here, and the meritocracy. And I think some of it's changed over time, but I think, the idea that, if you come as an immigrant, you can really kind of achieve whatever you sort of work hard to do. And then have people be like, wow, how'd you do that? Tell us how you did that. That sort of attitude I would love to bring back into Australia more. In Australia, there's a little bit more of a, they call it the tall poppy syndrome, where they don't want anyone to kind of grow higher than anybody else. There's like a lot more, it's more of an egalitarian system where, you can be successful, you just don't show it, don't talk about it. Like we're all successful, mate. No, it's all good, like that. So I think that that attitude would be great, because I think what America does amazingly well is, we do big things. Our attitude at our company is like, oh, life science. Yeah, we can get into that. Why not? Why wouldn't we want to get into that?
Right.
We can figure it out. And I think that's, and Aussies have that attitude too. It's just the execution there's more scale here. So, you can really get stuff done. So
Got it.
I don't know if that was a direct answer to the question, but
no, I like that answer. I probably should have ended with that question, but let me ask a couple lightning round real estate questions. And it's sort of that ilk though, of, I guess, things that you want to accomplish. So how about this? Is there a market that CEI hasn't gone into that you would like to get into in the next couple of years?
Yeah, I think there's a couple. Utah, Salt Lake City is a market we've been, knocking on the door for a while, and never been able to find our way in. I think similarly in North Carolina, those are probably the two that jump out. I mean, we have presence in about 13 or 14 markets around the country, but there are a couple that are definitely on our radar, those two, and a few others, but those are probably the two major ones.
Yeah. Do you think over the next couple of years you're going to do more development deals or more value add existing deals?
I think we're going to do more value add, but not in the place of development. I think they're both going to grow. I mean, I think from our perspective, we have a very robust development business and a line of business. It's well staffed. We've got offices around the country with experts in those local markets. We've got a great pipeline. That pipelines, we're never going to shut that off, because that's just part of our DNA, and we love doing it. And so I think that we want to try to acquire more and catch up in volume terms to that development pipeline. So just by the sheer fact that we're starting from a much lower base of assets under management, that's going to be more prevalent, I think. And I think also with the realignment of basis, and the opportunities that we think are going to happen just by virtue of what happened and changed so quickly in the debt markets, I think we're going to end up having more acquisitions opportunities. But we still see a ton of development opportunities, and we believe in the markets that we're in, and we want to do both, basically.
Yeah. All right. Final question here. What do you wish? What if you could tell you're only 26 years old now, right? So I always say, yeah. So I always say, what do you wish you could tell the 25-year-old self? One bit of advice. The 25-year-old Adrian Berger, rolling around in Sydney, Australia.
Yeah, it's a good question. I think that I was sort of later to realize that real estate was my passion and not just a hobby or part of our family business. I would tell that Adrian to invest in real estate earlier and more, and not be so nervous about doing that. Obviously, do the diligence or whatever, but just have a bit more courage around going for it and seeing what happens.
Yeah. Well, we all like to be more. Right? Yeah.
I think one of the things I love to do is to meet with younger people, and I always encourage them to do that. I think that I'm fortunate enough that I've moved around a lot in different cities and different parts of real estate and different careers, and I think anything is possible. And so I encourage those people to just go for it. They're young, they don't have any any major responsibilities like kids and a mortgage or anything like that. And so that's the time to take a risk and to take chances and have fun, because before you know it, 20 years goes by and you're still having fun. It's just a different kind of fun. So you got to take advantage of that while you've got it in your 20s.
Yeah. The only difference is in your 20s, you're still up at 2 a.m. because that's you just got home from the bars. And now for us, we're up at 2 a.m. and that's because our kids wake us up and we're frustrated that we're up at 2 a.m.
Yeah, exactly. It's the same. It's the same thing being awake, but different cause. But it's all fun. You can't take it too seriously. You gotta wake up every day and just realize there's opportunity. And this is the other thing about what's great about America. It's it's a land of opportunity. You guys have this great attitude, and so I think that there's opportunity always. And I think whether you're 25 or 45, there's still room for fun and hard work. And I don't know, you gotta wake up and enjoy every day and take advantage of it.
Well, Adrian, I truly appreciate you coming on to Real Talk. Literally, there isn't one person in our community in LA and Southern California, when your name comes up, everyone says great things about you. There isn't one person who could say a negative thing. And CEI is just has such a great reputation, and you are part of that, and not just locally but regionally and nationally. And so it's an honor to have you on my show, and best of luck to the rest of 23 and years to come.
Andrew, thanks so much. Very kind words. I'm really grateful to be on the show, and look forward to seeing you soon. Thanks a lot.
All right. Thanks, man. Thanks, Adrian.
See ya.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsch. You can catch prior episodes at scholarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.